You know how numbers can tell a story? Sometimes it feels like they whisper, other times they really shout. Today, we're trying to cut through some of that noise. We're diving deep into, well, the real language of corporate finance. We're going beyond just the headline profit number to figure out what really drives a company's health, its sustainability, and, its ability to create value long term. We're talking cash flow, specifically operating cash flow OCF and free cash flow FCF. And we're looking at this through the lens of the 10 biggest companies in the S&P 500 over the last decade, 2015 to 2024. We've got a ton of analysis, research, a pretty comprehensive 10-year study to help us.
Okay, let's unpack this.
Yeah, absolutely. Financial statements, they can feel like a maze sometimes, right? But understanding cash flow, it's like having a GPS. It cuts straight through at what's actually happening financially. Our mission today is really to give you that clearer lens, to help you see how the cash-generating power of these giants has evolved. It reveals so much about their strategies, past and present, and frankly, the big bets they're making on the future. Okay, so to really get why cash flow is so important, we kind of need to start with why profit, net income, sometimes doesn't tell the full story. Net income gets all the headlines, we know that, but it's accrual-based, it's got estimates, non-cash charges baked in, it doesn't always reflect the actual, moving in and out. Sometimes it's a bit of a financial illusion.
Exactly. An illusion is a good word for it sometimes. And the statement of cash flows, that's designed to pierce right through that. And within that statement, operating cash flow, OCF, that's really the engine. It's the core. It's the net cash just from the day-to-day running of the business, nothing else. It's probably the purest measure of whether the core operations are actually working, financially speaking, sustainable. Think of it like, how good is the company at turning its main business into actual spendable cash?
Okay, the engine. I like that analogy.
Yeah, and if that OCF is consistently positive and ideally growing, that's a huge green light. It signals a healthy business, one that can fund itself.
Right. Makes sense.
And building right on that, we get to free cash flow, or FCF. So if OCF is the engine, FCF is kind of like the high-octane fuel left over. It gives the company strategic choices. It's the cash that's remaining after the company has paid for all its operational stuff and covered its capital expenditures, CapEx.
Ah, CapEx. The investments to keep things running and expand.
Precisely. The critical investments in buildings, equipment, tech infrastructure, all that. So FCF is the discretionary capital, the real financial firepower left over to, say, pay dividends, buy back stock, pay down debt, make acquisitions, or pour into big new projects. Yeah. Honestly, for assessing long-term shareholder value, FCF is arguably the single most important number to track.
That idea of discretionary power really hits home.
Okay,
for our audience who gets the basics, let's touch quickly on how these are calculated. We know OCF starts with net income,
right,
and then adjusts for things that aren't cash.
Right.
Which adjustments should analysts really be watching closely? Where are the hidden insights?
Great question. So yeah, start with net income. Then you add back non-cash expenses. The big ones are depreciation and amortization, D&A, and often stock-based compensation, SBC. These reduced net income, but no cash actually left the building.
Okay, standard stuff.
But for me, the really insightful bit often comes from the adjustments for changes in net working capital. These aren't just like accounting tweaks. They show timing differences in the cash cycle. Crucial stuff. For instance, if accounts receivable shoots up, maybe sales look good, but the company isn't collecting cash fast, that actually uses cash. It's a subtraction from OCF.
Ah, right. Even though profit is recorded.
Exactly. Conversely, if accounts payable jumps up, they're essentially getting short-term, interest-free loans from their suppliers. That's a source of cash in addition. So the formula is basically OCF net income plus non-cash expenses, changes in net working capital. And seeing OCF consistently at or maybe even above net income, that suggests good earnings quality. The profits are backed by actual cash.
And negative OCF.
Oof. For a mature company, that's usually a big red flag. Serious questions need asking there.
Got it. Okay, so that's OCF, the operational engine. Now, moving to FCF. This is where those strategic investment decisions really show up, right?
Totally.
It's OCF minus capital expenditures. Simple math, but profound implications. CapEx being the cash spent on, buying or upgrading long-term stuff, PP&E, infrastructure, found in the investing activities section.
And that subtraction of CapEx is exactly why FCF is so potent. It's the bedrock for valuation models like discounted cash flow, DCF analysis, which tries to figure out what a company is truly worth. FCF directly funds shareholder returns, signals financial flexibility. It's just a much tougher, more exacting measure of profitability than net income because it accounts for the real cash cost of maintaining the business and investing for growth.
So a company could look profitable on paper with net income.
Right, but if it has to plow every single penny of operating cash right back into CapEx just to stay competitive, just to tread water, well, it's not actually generating much free cash for its owners. Not much economic value creation there. We also look at the FCF to OCF conversion rate, FCF, divided by OCF. How much OCF makes it through to become FCF?
What does that tell you?
A high rate, say 80–90% or more, often means an efficient business, maybe asset light like software. A lower rate might mean heavy investment cycles. Not necessarily bad if it's strategic investment for future growth, like building factories or data centers.
Okay, that makes sense. Now, given how powerful FCF is, why do we still hear so much about EBITDA? It gets thrown around constantly. Why not just use that? It seems simpler.
EBITDA. Yeah, it's common, but honestly, it can be really dangerous to rely on it as a proxy for cash flow. Look, EBITDA earnings before interest, taxes, depreciation, and amortization, it has its uses. Maybe for comparing core profitability across companies with very different debt levels or tax situations. But it's fundamentally flawed as a measure of cash generation. It ignores critical, real cash outflows.
Like what?
Like actual cash paid for taxes, actual cash paid for interest on debt, changes in that working capital we just talked about. And crucially, it ignores capital expenditures. You could have amazing EBITDA, truly fantastic numbers, but be burning through cash like crazy because of massive CapEx needs or huge debt payments. Relying only on EBITDA, it gives you a potentially way too rosy picture. It completely misses the real cash demands. You need OCF and FCF for the real story.
Okay, message received. EBITDA isn't cash flow. Got it. All right, so we've got our tools. OCF for operational health, FCF for discretionary power and value creation. Now let's apply them. We dug into this 10-year study, 2015 to 2024, for the 10 biggest S&P 500 companies. A decade of huge change. And the numbers, well, they tell some fascinating, very different stories about business models and strategies.
They really do. Let's start with the tech titans. These companies are just, unprecedented cash machines, but each one has a very unique cash flow fingerprint.
Where should we start?
Let's kick off with Microsoft. Their big pivot, to cloud first. It's basically created this incredible cash flow annuity. Their OCF growth has been remarkably stable, really predictable. It went from about $33 billion back in 2016 to a projected, $136 billion for 2025? Just massive growth.
Wow, that's incredibly consistent.
It is. Yeah. But here's the critical recent trend. Look at their CapEx. It's absolutely surged. From around $24 billion in 2022 to an estimated $64.5 billion in 2025. That's not just routine upgrades. That's a huge bet on AI and cloud dominance for the next decade. They're pouring that steady OCF back into building the future platform.
So trading some near-term FCF flexibility for long-term strategic positioning.
Exactly. A massive reinvestment. Then you have Apple, just a titan of free cash flow generation.
Yeah.
Often clearing over $100 billion a year in SCF.
Just staggering numbers.
It really is. And it speaks to their model, right? Premium pricing, ecosystem lock-in, the high-margin services division contributing more and more. Their CapEx, compared to someone like Microsoft building data centers everywhere, is relatively modest. It reflects a less capital-intensive core business. And what do they do with that colossal FCF? The biggest share buyback program ever seen. Billions and billions returned directly to shareholders. A cash compounding machine.
Though you do hear the criticism sometimes, right? That maybe they should be investing more in bold new things instead of just buybacks.
That's the perennial debate with Apple, isn't it? Some see the buybacks as maybe a lack of new, huge growth avenues. Others see it as incredibly disciplined capital allocation. They're saying, if we can't find internal projects that meet our high return hurdles, the most efficient thing is to give the cash back to owners. It signals confidence in the current cash cow.
Okay. What about Alphabet, Google's parent?
Alphabet, powered by digital ads, historically just a phenomenal cash engine. OCF grew from maybe $26 billion in 2015 to over $125 billion last year. But again, look at the last 2 years. A huge strategic shift. CapEx, which used to hover in the $20–30 billion range, suddenly exploded really to over $52 billion in 2024. Why? Generative AI, same story as Microsoft, essentially. FCF growth has stalled. even with strong OCF, because they are all in on AI infrastructure. It's reshaping their whole capital plan.
A clear pattern emerging with the big cloud AI players.
Definitely. Now, Amazon is fascinating. It's like two companies in one from a cash flow perspective. You've got this super high margin AWS cloud business throwing off tons of OCF. And that cash then fuels the incredibly capital hungry beast that is their global e-commerce and logistics network, building warehouses, delivery networks that cost billions.
So FCF must bounce around a lot.
Hugely volatile. Back in 2021, 2022, they were in a massive investment cycle. CapEx soared over $60 billion a year. FCF went deeply negative. But that wasn't necessarily bad. It was strategic investment. You can't judge them on 1 year. Then as that cycle matured in 23 and 24, CapEx cooled off a bit, and boom, FCF recovered sharply. Context is key.
Multi-year investment cycles, got it.
Then there's NVIDIA. Wow. What an explosive story. From a successful chip company to just cash-generating juggernaut because of AI GPUs, OCS went nuts, like $5.6 billion in fiscal 23 to projected $64 billion in 25. But here's the kicker. Their business model is relatively asset light. They design chips, others manufacture them. So CapEx didn't explode nearly as much. Result, FCF surged even more dramatically, $3.8 billion to nearly $61 billion in just 2 years. That's incredible efficiency meeting transformative tech.
Almost pure profit dropping to the bottom line, effectively.
Almost, yeah. Incredible margins and conversion. Meta Platforms, Facebook's parent, also strong OCF from ads, $10 billion in 2015 to over $90 billion now. But again, look at FCF relative to OCF, especially from 2022 onwards, it dipped significantly. Why? Massive CapEx jump. Went from maybe $18 billion in 21 to over $37 billion projected for 24. First, it was the metaverse push. Now it's heavily AI infrastructure. Same reinvestment theme, sacrificing near-term FCF for long-term bets.
Seems like AI is forcing everyone's hand.
Pretty much. Let's switch gears slightly. Broadcom. Very different strategy. They're an acquisitive cash flow compounder. They buy profitable semiconductor and software businesses, then optimize the heck out of them for cash flow. And it works. Consistent OCF grows from $2.3 billion in 2015 to nearly $20 billion now. And crucially, they keep a tight rein on CapEx. Their OCF to FCF conversion is exceptionally high, often over 90%. They generate cash, and they keep it free. Then use it for big dividends, debt pay down. Very disciplined.
Fascinating contrast. Okay, moving away from pure tech giants, Tesla's story is almost a perfect case study in cash flow evolution for a disruptor, isn't it?
Absolutely textbook. Tesla's 10-year journey really shows why you need context, why you need to understand the company's life cycle. Go back to 2015, 2018. FCF was deeply negative, hit almost minus $3.5 billion in 2017. Was the company failing? No. That was the cost of building the gigafactories, scaling production, massive necessary CapEx. They were burning cash and relying on raising capital.
The investment phase.
Exactly. Then the inflection point around 2019. Production ramps up, OCF turns strongly positive, and finally starts outpacing CapEx. By 2022, Tesla generated over $8.5 billion in FCF. A huge turnaround, validating that long-term heavy investment strategy. It shows you can't just look at one snapshot of FCF.
So important to see the trend and understand the why behind it. Okay, now for some outliers where these standard metrics get.
Right. Berkshire Hathaway first. It's a giant conglomerate. Its OCF is a blend from insurance, railroads, utilities, manufacturing, totally diverse. The FCF that bottles up from these operating units after they've met their own reinvestment needs flows to the corporate level. And Buffett and his team allocate that FCF, but mostly not via dividends or buybacks. They use it to buy stocks or acquire whole company. So it's a two-level analysis needed there.
Different kind of capital allocation.
Very different. And then the really crucial one for context, JP Morgan Chase and banks in general. Here, standard OCF and FCF metrics are not just volatile. They can be downright misleading. They're often negative. Now, for a tech company, negative OCS is alarming. For a bank, it can actually be a sign of growth.
Wait, negative OCF is good? How does that work?
It's totally counterintuitive, right? But think about it. What's a bank's main operating activity? Making loans. When a bank makes a new loan, that's cash going out the door. It's an operating cash outflow. When it takes in new deposits, that's an operating cash inflow. So a bank that's growing fast, writing lots of new loans, it will show big operating cash outflows. The standard OCF calculation is just fundamentally misaligned for how banks operate.
Wow, okay. So OCF and FCF just aren't the right tools for banks.
Not meaningful metrics at all. Analysts use totally different things. Net interest income, return on assets, return on tangible common equity, efficiency ratios. You absolutely cannot apply the same cash flow framework. It's a critical distinction.
That is a massive takeaway. Context is everything, especially there. Okay, so bringing this all together from the study, what are the big conclusions? We see who generates the most FCF, but there's a deeper strategic story too, right?
Definitely. In terms of sheer volume, Apple is king.
Yeah.
Generated something like $800 billion in FCF over the decade. Just mind-blowing. But if you look at efficiency FCF margins, OCF to FCF conversion, Microsoft and Broadcom really shine. Their software-heavy, high-margin models are incredibly efficient at turning revenue into free cash. And NVIDIA, well, its FCF growth rate recently is just in a league of its own due to the AI boom and that asset-light model.
And the big strategic theme.
It's crystal clear, especially from 2023, 2024 onwards, the AI capital expenditure supercycle. Microsoft, Alphabet, Amazon, Meta, they are all dramatically ramping up CapEx, pouring hundreds of billions collectively into AI infrastructure. It shows a shared belief. AI leadership is paramount, even if it means less FCF for shareholders in the near term. It's a huge strategic pivot towards reinvestment for future dominance.
Reshaping priorities across big tech.
Absolutely. So, to recap the core ideas, OCF shows you the operational health is the core business actually making cash. FCF shows the economic value created and the strategic flexibility. Asset-light models convert cash efficiently. Capital-intensive models need huge reinvestment. And context, like with Tesla's growth phase or especially banks like JPM, is absolutely critical. You can't just apply formulas blindly.
Okay, fantastic insights. Now, for you listening, how can you take this knowledge and apply it right away? We've boiled it down to a kind of checklist, right?
Yeah, a practical guide. Ask yourself these questions when looking at a company. 1, is OCF consistently positive? And is it growing? That's your baseline for health. 2, how does OCF compare to net income? Ideally, OCF should be at or above net income over time. If it's consistently lower, dig into why. Earnings quality might be low. 3, what's the CapEx trend? Are they investing heavily for growth? Just maintaining? Did it suddenly spike? That signals strategic intent. 4, is FCF consistently positive? And what's that OCF to FCF conversion rate? This tells you about efficiency after reinvestment. And finally, 5, how is the company using its FCF? Dividends, buybacks, paying down debt, big acquisitions, R&D. This reveals management's priorities and their vision.
That's a great framework.
Getting a nuanced handle on OCF and FCF, it really moves you beyond just looking at reported earnings, which can be, well, simplistic or even misleading. It gives you a much deeper, more resilient way to find high-quality businesses.
What a fascinating dive into the real cash engines of these market giants. We've really seen how OCF and FCF tell a much richer story than just the bottom line profit number. They reveal strategy, priorities, the real health of a business. So a final thought to leave you with. Think about how fast these cash flow profiles are shifting, especially with something like AI demanding this massive reinvestment. What does that tell you about where capital might flow in the S&P 500 over the next decade? Which companies are truly betting big on the future?
Keep asking those deeper questions. Where does the cash really come from, and where does it really go, and why? The more you dig into these numbers, the sharper your insights will become.